I have a theory about stock market bubbles. Bubbles don't come out of thin air. They're based on reality. There's a solid foundation, but there is a misinterpretation, a misconception. And then things are carried too far. Initially, they are self-reinforcing. The false idea is reinforced by reality. It gathers momentum. Then it becomes too far removed from reality, becomes unsustainable, and you have a collapse. That's what you had in...
Now stop there, and let's just use one example to understand how we can take that application and apply it to America today. The most recent bubble was the dot-com
bubble. Yes.
Okay, tell me what was the reality, what was the irreality, and what happened, and what do we look for that explains that, and then take that understanding and apply it to foreign policy.
You take the Internet.
Right.
It was a great innovation with great potential. It was misinterpreted as a potential source of enormous profits.
Yeah.
Now,
and the creation of a new kind of wealth.
Right. And that misinterpretation actually affected the fundamentals. But it wasn't just a stock market phenomenon, but it actually influenced the development of the industry. The use of the Internet was accelerated by the bubble. So it was self-reinforcing. Reality actually moved in favor of the bullish bias that was prevailing in the market. It got carried too far, and then you had the collapse.
Because the stock market prices had nothing to do with the reality of earnings.
Well, as I say, they were exaggerating the prospects, but the exaggeration actually reinforced the possibilities that Internet companies had. It actually accelerated a kind of a feedback mechanism between reality and the stock market perception of reality. It's a feedback mechanism that initially was self-reinforcing and then became unsustainable and led to the collapse.